Biggest financial asset that you have going for you by miles is the value of your own earning power over the years.
Warren Buffett, one of the world's most successful investors, has a set of rules he follows to pick out the right companies to invest in. This is how to become a successful long-term stock investor like Warren Buffett. This financial education will break down the Buffett investment method and teach these 7 rules. All investors, no matter the size of their accounts, may follow these basic rules to be successful. You can use Buffett's strategy if you have $10 or $1 million to invest. What he says makes a lot of practical sense. It's worth considering as you make your own investment decisions. Next time you invest your money, try following these rules to pick the right companies. Welcome back to the Ring of Knowledge, your trusted source of practical financial knowledge. Today's video will discuss Warren Buffett's 7 rules for stock investing that you must know. Invest in what you know. Going to get involved in investments that are too difficult to understand is one of the simplest ways to make a mistake that you can avoid. Many of us have spent most of our professional lives working in little more than a half-dozen distinct fields. We presumably have a solid understanding of how these particular marketplaces function and the organizations currently leading the pack in this industry. Most publicly traded corporations are involved in fields where we have little to no first-hand experience. Never invest in a business you do not understand, claims the adage Warren Buffett. This does not preclude the possibility of making financial investments in the market above segments. However, we must proceed cautiously. Our view is that most organizations run operations that are too complex for me to understand comfortably. We are the first ones to admit that we cannot foresee the success of a medication pipeline for a biotechnology business, identify the next significant fashion trend in teen clothes, or pinpoint the next technological breakthrough that will fuel growth in the semiconductor chip industry. These kinds of complicated problems have a significant impact on the earnings created by many businesses operating in the market. It is still being determined whether or not they can be predicted. Our response to such a company when we find it is always the same: pass. Far too many opportunities are available to get bogged down in investigating a firm or sector that needs to be more challenging to comprehend. For this reason, Warren Buffett has traditionally refrained from investing in the information technology industry. Within the first 10 minutes, if we need to obtain proper knowledge of how a company makes money and the primary drivers that affect its industry, we move on to the next proposal. Fewer than a few hundred businesses out of the more than 10,000 publicly traded corporations today match our standards for the ease of which they conduct their operations. Never put only an idea that can't be combined with crayon drawings. By sticking inside our circles of competency and picking up some Crayolas, we can prevent many mistakes. Find your passion. To create fantastic results in your life, you must discover what you are passionate about and pursue that passion. This is something that almost every successful person agrees on. Even Warren Buffett gives to this line of thinking. During an interview, he stated that he considered himself fortunate to have figured out what he enjoys doing at an early age, and he claimed that if people realized what they were passionate about, their lives would alter drastically. There is no affirmation that you will be able to discover your passion in your first job, but you have to keep exploring until you do find it. When he was asked to give a commencement speech at Stanford University, Steve Jobs did so and claimed, "The only way to generate exceptional work is to be passionate about what you do. If you do not have a passion for what you're doing, you will only give it half of your effort, and there is no way that you will ever become the best in this manner." Therefore, the best way to achieve incredible success is to zero in on what you're genuinely passionate about and spend your time doing that. Your work will take up a significant portion of your life, and the only way to find true contentment is to accomplish the kind of work that you consider outstanding. And the only way to do excellent work is to have passion for what you want to do. Continue your search if you still need to find what you're looking for. Don't settle. You'll recognize it when you do. Just like with other essential things in your heart, never compromise on business quality. These ideas led Buffett to say the famous quote, "It's much better to buy a great company at a fair price than a fair company at a great price." Warren Buffett. Finding high-quality firms is more complex than rejecting sophisticated businesses and industries, which can be done in an elementary fashion. Throughout the past half-century, Warren Buffett's investment philosophy has shifted to almost entirely centered on purchasing high-quality companies that offer long-term prospects for continuing expansion. Some investors may be taken back to find that the name Berkshire Hathaway was derived from one of Warren Buffett's less successful businesses. Buffett was persuaded to purchase the company Berkshire, which was in the textile manufacturing industry, because the price of the business appeared to be low. He trusts that if you bought a stock at a sufficiently low price, there would almost always be some unexpected good news that would allow you to sell the position at a decent profit, even if the long-term business performance remained terrible. This was his theory. As Warren Buffett gained more years of expertise, he modified his approach to the so-called cigar butt investment strategy. He stated that if you are not a liquidator, using that approach to purchasing firms signifies foolishness. The initial cheap price will probably not turn out to be as good of a deal as it initially seemed. In a challenging industry, it seems like no sooner do you overcome one problem than another one appears. The profits that these kinds of businesses often generate are also typically relatively modest, which further erodes the value of the initial investment as time passes. Return on invested capital is the essential financial measure we consider when evaluating the quality of a company. Companies that generate high returns on the capital invested in their firm can compound their earnings far more quickly than companies that generate lesser returns on their investment. Consequently, these businesses' inherent value continues to increase over time. Be sure that you are comfortable with the company's business quality before you give in to the temptation to buy a dividend stock yielding 10% or snap up shares of a company trading for just 5 times earnings. Remember that doing so, you will be avoiding giving into the temptation to buy a stock that pays a dividend and will earn 10%. The existence of an economic moat can typically be inferred from the presence of high returns on capital. We favor investing in businesses that produce high returns on invested capital, 10 to 20% or more, and are consistent. Don't care what others think. He is not overly concerned about what other people think of him. And this is of the utmost importance because if he wants you to consider what other people have to say, his judgment will be impacted and he will never be able to keep onto his investment ideas. If Warren Buffett were to pay attention to what other people say, he would lead a life more typical of the average person rather than a life in which he amassed $1 billion and is so successful in the stock market. The same considerations apply to you. When it comes to obtaining the success you desire and living the life of your dreams, there will be individuals who tell you that it is impossible to achieve what you want and suggest you acquire a real job instead. Never pay attention to those who are negative. You need to listen to your instincts and act following what you believe to be correct. Warren Buffett is well known for popularizing the circle of competence, a strategy he employs to limit the scope of his business activities to those in which he possesses the most extraordinary expertise. This idea emphasizes that each of us has amassed information that applies to particular fields and that we need to focus our efforts on those fields in which we excel to be successful. Ignore what people have to say about other things for now. It is inherent in the human condition to seek validation and approval from others. However, doing so will cause you to obsess over what other people think of you and what they say about you. It will also prohibit you from enjoying the best life possible according to the terms you set for yourself. When you give too much importance to what other people think and say about you, you will stifle your freedom and be a prisoner of theirs forever. If you buy a stock, keep it forever. How long should one hold onto a firm after purchasing it at an affordable price if the business is of good quality? If you aren't planning on holding onto a stock for the next 10 years, you shouldn't even consider buying it for the next 10 minutes, claims financial expert Peter Lynch. Our favorite holding period is forever. Warren Buffett. There is no denying that Warren Buffett subscribes to a buy and hold investment philosophy. It has been decades since he has held several of his posts. Excellent firms generate excellent returns on their investments and see their values rise over time. Time is the buddy of a fantastic business, as Warren Buffett put in one of his speeches. Investors who are patient enough to wait for a stock's fundamentals to affect its price will be rewarded. The last point is that trading activity is the adversary of investment gains. Frequently purchasing and selling stocks can reduce returns due to the impact of taxes and the inability to make well-timed decisions because of our innate behavioral biases. Instead, it would be our advantage to purchase properly and sit tight in most cases. The motive of the stock market is to move money from those who are active to those who are patient. Warren Buffett. Have a margin of safety. Benjamin Graham is credited with being the first person to introduce the concept of a margin of safety. Warren Buffett, who is often regarded as Graham's most successful student, was exposed to the idea and made astute use of it in his portfolio of investments. The idea is simple to grasp, and Warren Buffett frequently explains it by comparing it to driving across a bridge as an analogy. When you design a bridge, you make sure it can support 30,000 pounds, yet the heaviest vehicles that pass it weigh only 10,000 pounds each. You have a safety margin of 20,000 pounds available to you, and if you want to be successful in the world of investment, you should only pay $60 million for a company worth $50 million. As a precautionary measure, you have decided to purchase the company at a price lower than its current market value of $50 million. In finance, a financial institution will never grant you a loan if they believe you have the difficulty meeting the monthly interest payment obligation. If something goes wrong in the future, the banks will ensure that you have additional funds available to pay for the installment of the loan. This idea is fundamental to the value investing notion that has been outlined. Before diving headfirst into the purchase of a stock, it enables investors to make more informed and prudent choices. Be greedy when others are afraid and fearful when they're greedy. When making choices about investments, you shouldn't do what everyone else does. This is the last piece of advice you should accept from Warren Buffett. One must rely on one's prior expertise in the market to become a successful investor. When a large number of investors have a good attitude about a specific stock, the price of that stock will go up. This is what Warren Buffett is attempting to convey here. You would end up overpaying for the stock and would not receive comparable returns if you made such a transaction. This brings us full circle to value investing, which entails selecting stocks with a high intrinsic value but trading at a lower price. You must remember the following point. You shouldn't try to be different. Rather than going along with what other people are doing, you should listen to your intuition and act accordingly. Although Buffett has had a successful career in the market, this does not mean that he has not experienced setbacks in his financial situation from time to time. Buffett suffered a personal loss of $23 billion due to the recession that began in 2008, and his company's income fell by 62% during the same period. The lessons you should take from Buffett's experiences are that investing requires constant learning and relearning. It comes down to taking calculated risks when deciding which firms to invest your money in. It would help if you did extensive research on the company whose stock you wish to buy and then relied on your judgment when making purchase decisions. Investing is much more complicated than it has to be for us. Warren Buffett is known for adhering to a straightforward strategy that is grounded in common sense. Because we've spent over a decade working in the financial sector, we can connect to his advice on investing, but it can sometimes be complicated to put into practice. We can improve our portfolio management, reduce the number of mistakes we make, and get closer to achieving our objectives if we take some of the investment advice that Warren Buffett has provided and put it into practice. This advice includes concentrating on the long term, maintaining a focus on blue chip dividend stocks, and staying within our circle of competence. So that's all for today's video. If you like this video, click the like and the bell buttons. We'll have another video for you soon. Take care until then.